Hey folks, how's it going out there? Hope everyone's having a great weekend. Figured I'd talk a little bit about a subject that I get asked about a lot, and that is swing trading, or really trading along longer time frames and some of the best practices, how to get into it, how to avoid some of the common pitfalls that people can get stuck in. I figured this would be a great time to talk about it because, a lot of folks are not really sitting at home all the time anymore, right? The world of day trading has changed quite a bit, and now people are focused more on longer and longer time horizons. So it's a great time to talk more about how to swing trade. And I'd like to talk about it from what I've learned from the 19 years of trading experience I have so that you can cut out some of the pitfalls I've experienced so you can accelerate your journey, become more consistent, and trade in a way that doesn't require you to watch the market really all the time. Because, being stuck behind the screens all the time can be a little bit exhausting. Let's be real about that. So let's dig right in. First, let's have just a little disclaimer. There is a very high degree of risk involved with trading. Past results are not indicative of future returns. TraderAid.com and all individuals affiliated with the site assume no responsibilities for your trading and investment results. All right, with that out of the way, let's get right into it. First, let's talk about the keys to consistency in swing trading, because this is one of the most important elements of swing trading successfully is being consistent. That means having a system and sticking to it. That is easily the most important point that I'm going to keep driving home. And that's why it's on top. So if you don't have a system, quite frankly, I don't think you should be trading. And I'm not trying to say this to look down on anyone or what you're doing, but it really is about being able to look at trading more as a business. Can we be solvent? Can we understand what we're doing so we can replicate it? If so, when we have a system that works for us, that's great. If we don't, we need to go back and re-examine what is we're doing and why. Also, not over trading. This is so important. I understand that it feels good to have skin in the game and it's exciting and we always want to kind of feel like we're involved with the market. But quite frankly, there's no need to do that. A lot of better trades are going to happen from waiting for better setups, from being patient, and from sticking to your system rather than letting emotions run your portfolio. And managing risk is the most important part of that consistency. Part of that is your system. Part of that is really just making sure that as you have a system, you follow it, right? So if you're going to qualify how large of a position to take, part of that should be on the basis of, okay, well, how much am I willing to lose? And if you don't want to lose, enough that you can't keep trading, you've got to have a system in place. So my system, and I wrote about this in an article yesterday, is the 1% rule. Okay. So that means sizing trades so that you're not going to lose more than 1% of your account on any trade. And we'll get into that a little bit later. I also really recommend journaling all trades. I think it's so important to journal because when you're journaling, you're accountable. No one's going to help you trade and care about your financial future more than yourself. So I know there's a lot of folks out there that run services that call shots. They tell people when to get in, when to get out. If you're not learning how to get in, how to get out, if you're not learning why you're getting in and why you're getting out, you can't necessarily replicate that process. And if you can't, you're not really learning how to be a trader. You're learning how to copy other people's trades. I find it's much more valuable to learn how to trade on your own, to be able to have a system that you can understand and be consistent within. Because if you're following someone else's trades, you're not necessarily going to have the conviction or the understanding to understand what you're doing, why you're doing it, and most importantly, how to replicate it. The other thing I think is important to take a more systematic approach is back testing. I know it sounds a little boring to some folks, but the reality is having the data that qualifies our approach is really, really, really important, right? If we understand how certain instruments will trade under different market regimes, what kind of signals may qualify an entry or an exit, that's going to better prepare us to know when we're supposed to be getting out in terms of capturing gains or realizing risk. And finally, I talked about it a little bit, but understanding the trading environment we're in, right? There are really three states to an auction. There's demand exceeding supply, which is an uptrend. supply exceeding demand, which is a downtrend, and a balance between supply and demand, which is basically a market in consolidation. Each one is going to have different trade setups that can work better than others. For example, using RSI to qualify overbought in the context of an uptrend doesn't really work well, but it can work well to qualify oversold in the context of an uptrend or overbought in the context of a downtrend. Let's briefly discuss psychology. I know I did a webinar about that recently. If you missed it, you can catch it on my YouTube. And that's pinned right here on the top of my Twitter feed if you're watching on Twitter. So we should strive to be objective and systematic to have a better chance at success. Trading is much more a science than an art if you want to be able to be consistent at it. That sort of longer term momentum trading is much more about using signals and managing risk and then capturing gains in the trades that work out than just sort of winging it, which means like there's nothing wrong with technical analysis and using that if that works for you. But I think for many, to be able to take some of the emotion and subjectivity out, having a data-driven approach actually works better, which is one reason I will continue to emphasize the importance of backtesting. And we should not let our emotions govern our trading in any way. If you go to bed every night anxious and you're having trouble sleeping and you're thinking, what's the market going to do the next day? You're in too big of size. You need to scale down. If you're going in the market and you don't care about how your positions move at all, that's a start. But if you're so apathetic, you're not managing them, maybe you're not in enough, if that makes sense. There's a balance. There's a balance that draws our attention and kind of encourages us to be diligent as traders, but not being so oversized that it's actually causing anxiety. Now, journaling is really important. This is another part where trading is more like a business than it is like a hobby. It really does demand your full attention to do it well, to do it consistently. Now, how do you do it well? How do you do it consistently? Well, you have to be accountable, which means you have to have a track record. So having a journal, even if it's something as simple as a spreadsheet, is absolutely fine. Because what you can do is you can historically contextualize what sort of trades work for me, what sort of trades don't work for me, what type of environments do I trade well in, what type of assets do I trade well, and then you can start to get a sense as to what works for you. It's really important to do this for another reason. And that reason is that you don't know how you're going to trade. You don't know what's going to work for you, particularly if you're newer at this game and you haven't really gotten your legs. That's why this is a 101 course. This is really a webinar for beginners, right? So if you're new at this and you're trying to kind of figure out how do I do this well, the first thing is trading is a journey of self-discovery. The reality is you're learning about yourself. So in that journey of self-discovery, journaling helps you to better figure out what instruments suit my personality, what trading style suits my financial goals and my risk tolerance, what position sizing am I most comfortable with, right? Then you can start to feel what works for you. What works for me, what works for other people may not fit what is your best system. And that's one of the reasons folks might look around Twitter and see some people that are projecting really great trading records or whatever and say, boy, why can't I be like that? First, you don't know whether or not that's absolutely real or a mirage, but more importantly, you don't know if what they're doing is going to work for you and whether it would work consistently. So embrace the journey of self-discovery. So in every journal entry, I think it's important to have the why, the how, and the what we entered, right? Like, why are we entering here? What's our theory? Let's document the thesis for the trade. Do we have a really compelling theory that keeps us, involved in terms of the price action, in terms of the overall, fundamental or macro elements, if we're even looking at that? And then how? How are we entering the trade? Are we going in all at once because we think we've just bottom ticked whatever the move is or we're at the perfect point? Or are we going to be a little bit more nuanced in our approach and allocate in, averaging in? Personally, I favor the latter. I don't like to just try to go in all in at once at a swing trade. Time is on our side. We may as well lean into that. and when we entered it, right? And what we entered. So are we buying stock, option, futures? What are we getting involved in? And what's the timeline of that for each entry? And whether we took on a full position or a portion, as I was discussing, I think it's important to scale in and out. But, everyone has a different way of approaching markets. And I can respect that. I also think it's important to document our emotional state. Were we fearful? Did that trade work out well? Should we be trading when we're fearful? Were we greedy? Did that trade work out well? Should we be trading when we're greedy? Were we vengeful? Were we hoping to trade something that we just took a loss in and reverse that? Is that realistic? Should we do that again? These are things that we should have in our journal so we can start eliminating bad behaviors just as much as focusing on good behaviors. And then what's our thesis behind the trade, including the risk and reward objectives? Because I like to qualify how I'm going to enter something in part by choosing the size based on the volatility, because the volatility of how something trades, that gives me a sense as to where my stop out should be. And if my stop out is going to be larger, then my position is going to be smaller to make sure I'm not losing more than 1% of my portfolio. So journaling allows us to have a better sense as to what is and is not working. It forces us to be more accountable. That can lead to better consistency and discipline. And also it helps with that journey of self-discovery. The next part is risk management. And this is such an important part of survival as a trader. People that don't manage their risk do not survive. And 90% of people that start off as traders do not end up as traders. I'm not saying that to discourage anyone. Quite the opposite. I'm saying that everyone is capable of being a trader, but there are certain behavioral patterns that you have to get into if you're really interested in doing this in the long run. One of those is having realistic goals. If you think you're going to get rich next week or next month, scale that back a lot. Enjoy the journey of learning, the journey of self-discovery, but also of learning about financial markets. Your initial goal should be capital preservation, not wealth. You're trying to trade at first to make sure you're not losing money. That's a realistic goal. Then from there, you build into capital appreciation as a goal. So qualify the volatility of what is being traded. There's a number of different ways to do that. In my swing trading article that's on my feed, I linked to an article on TraderAid that discusses exactly how to qualify volatility, whether you're looking at implied volatility, realized volatility, average true range, beta versus its benchmark. They're all different ways, and you can look at whatever works both best for you and the instrument you're trading. This is where backtesting becomes more important in my point of view. Stop placement will help you qualify that position sizing, right? So it's a 1, 2, 3 process. The first part of that process is understanding your vol. So when you know the volatility of what you're trading, you're going to know where your stop out should be. And when you know what your stop out level should be, you're going to have a sense as to what your max risk is going to be. And again, the Swing Trading 101 article goes into this part of it in terms of risk management. So I'm not going to repeat a lot of that here other than to say, when you know the volatility, you know your stop out. When you know your stop out, you know your position size proportionally if you're trying to make sure you don't lose more than 1% of your portfolio. And have a plan before you enter the trade, right? You really need to know what your goals are, what your risk is. And I like to have this plan have an objective for where I'd like to get out for my core, where I might risk off my runners, and then also where my maximum risk is for the whole or part of the position, right? So that's a big part of that plan. I also set timelines. If a trade's not working, I'm not going to stay in it forever. Time is a capital cost as well. So, I think that it's really important to have us qualify how long do we want to be in this trade before we move on to the next opportunity. And stick to the plan. Once we have a plan, one part of engaging consistency as a baseline behavior is forming that consistency from day one. So once you have a plan, you stay with the plan. Now, if after the trade you find the plan doesn't work or it could have been better, that's where you review your journal and you start figuring out how you may do this differently in the future. But you don't do it while you're in the trade, because that is going to encourage behavior that will not promote discipline or consistency or survival. The next part is backtesting. And this is a really important part of your trading journey. Backtesting is how we get a better sense of historical trends, and particularly when you contextualize them by specific market regimes and how they can affect different assets that we might be trading. So, for example, if you're in a bull market, backtesting prior bull markets for whatever you're trading can help you get a better sense for entry and exit signals. If you backtest the entire period of time, you may enter a little bit more noise and get a little bit less data that helps you qualify your entry and exit. So backtesting, but backtesting that is regime specific, I think is important. Now, when we talk about backtesting, there are a number of different ways that we can engage in that, right? So it is important to just kind of think about, hey, if you want to backtest, you can make it as simple or as complex as you'd like. That is the beauty of it. If you're new to it, there are tools for newer people like TrendSpider. If you're more intermediate, you'd like to get into some more coding, you can use TradingView. And if you really want to build a much more robust and customizable framework, Python can help with that. Okay, Python is easily the most capable language of building financial models and backtesting and even algorithmic strategies. There's even tons of existing libraries that help you jumpstart. So you don't have to write everything from scratch or reinvent the wheel. In fact, you just end up putting a couple spokes into an existing wheel and you end up having some pretty functional code. Now, auction theory, we talked about this a little bit. I think that understanding the regime you're in is important, both for your backtesting and your current trading, right? You're not going to trade a bear market the same way you're going to trade a bull market. You're not going to trade a market in consolidation the same way you're going to trade an uptrend. All of this nuance actually matters quite a bit because it helps you figure out what's more likely. And then from there, you can figure out which assets to trade that are benefiting from that environment. If you're in a bull market, you may not see everything appreciating the same way. There will be pockets of strength in certain sectors, industries, and single stocks that can benefit more than the entire market or some of the laggards or those that are just keeping pace with the market, right? So understanding where you want to trade you can get some sense of that from relative strength, and you can get a sense as the regime you're in from understanding the trends, from understanding the auction on multiple time frames. And I like to identify opportunities in a number of different ways for swing trades. So for traders out there that are trying to figure out like, okay, I like this idea of swing trading, but how do I figure out a setup? Because, maybe one is relying on a scanner, one is relying on a service, whatever. There's no wrong way so much as understanding what is the right way for you. Okay. I know that sounds a little bit vague. The reason it is that I've seen people take on swing trades for all variety of different reasons. But as long as they have data to support that approach and a system to keep them honest to it, those systems can work. They can build their own systems based on their own personality and the markets they like to trade. I'm going to talk about how I do it. So first, I like really looking at relative strength. So for example, if I'm looking at a sector or industry in the United States, comparing its relative strength to the S&P 500 over multiple time frames gives me a sense as to whether there's a bit of a rotation happening in there. If there's more excitement in that part of the market, that gets me more interested in taking a long swing trade. So we can see that in certain pockets of the market. It's something that we talked about in this week's market prep for TraderAid, that there were certain areas of opportunity based on relative strength and more cyclical components of the market. So, for example, one of the trades that I had on this year was fading 2-year note futures. The catalyst was the Fed's resolve being mispriced. When we got into this year, there was the idea of 6 or 7 rate cuts. I felt that was absurd, but that alone doesn't qualify a trade. You do need to see momentum and price action agree. So I did wait for those 2-year note futures to start to roll over before I started to build into that trade, right? And I've now since exited that trade because so far I've been able to capture the profit that I wanted to capture, and I'm able to say this is a good opportunity to look for others, right? So I flowed through the trade using my system of saying I had a thesis, I qualified it with the price action, I set my objectives for my core and my runners, I achieved those, and then I'm moving on to the next trade. Now, here are those 2-year note futures on screen, and you can see how I qualified this analysis. This is a little bit dated, as you can see, because we are in March here, but this was a trade where I felt like, okay, either we're going to break down or we're going to sort of consolidate in the level we're at right now. We ended up doing a bit more of consolidation than breaking down, and that was where I said, good enough. I was able to take off the last of my position there, my runners, and now I'm looking for opportunities in other spaces. But how did I get in this? I looked for the break below the 20-day moving average and the point of control in 2-year note futures on the front month contract. And then that was where I started to build my position. I added a bit to my position when we broke below the trend line, thinking we could even push lower here into this higher volume node. And as time goes on, we may indeed see that. But for the purposes of me not necessarily tying up my capital for too long, when we built this consolidation here and failed to really decisively break down, I closed the runners on that trade. And all in all, it was a profitable trade. Now let's talk about pair trades too, because this is an important part of swing trades. This is kind of how hedge funds tend to run as well. It is a little bit more sophisticated, but it is an important component because some people don't want to necessarily take one-sided risk. Right? They want to kind of balance things out with some long exposure and some short exposure. Now, I will preface this by saying the vast majority of everyone out there, including myself, is always net long. Okay? And I'm talking about across investment accounts, trading accounts, everything else. Everyone, pretty much the whole world, every fund manager, the vast majority, outside of short periods of deviation like Michael Burry and The Big Short and all that, most people in this world are net long. So even when you have a bearish thesis, even when you're thinking like the market's going to really take a turn for the worse, the reality is markets tend to grind higher in all kinds of different trading regimes, even when they don't seem likely to do so. And over long timelines, there's no reason to really bet against that. So you can have short-term hedges and short-term directional shorts, but going full bore, leveraged bear, shorting the market to zero, very few people can survive doing that, let alone make a profit. So it's an important clarification, and it's another reason why pair trading is important and one of my favorite ways to express swing opinions. Last year, my best pair trade, long the hedged Nikkei, that's HEWJ, and short FXI. Was long Japan, short China, but I didn't want to take the currency risk in Japan. So I bought the hedged Nikkei, and that was a banger. I put it on twice last year, and it handily outperformed the US markets in its returns. And I had a bearish view of China that played out, but I also had a bullish view of Japan that played out. And I qualified those views based on relative strength for Japan versus the world index, world stock index, relative weakness for China versus the same. And then also the macro thesis that, Japan is aggressively stimulating. Their market is objectively cheap. China is kind of cracking down to an obnoxious extent and destroying the confidence in their investors as they have this rolling real estate crisis. And that was a longer term pair trade that played out because I was able to qualify both the bigger overarching narrative, the theme, but also the price action. I can't get into that trade no matter how strong my opinion is unless the price action qualifies it as well. And you can set these types of charts up as well. It's very easy. You can go to like stock charts or TradingView or whatever your favorite charting place is. You can put on a ratio chart. So you're looking at one part long, the first part of the ratio, the second part short, and see if that relative strength of the long versus the short qualifies it. Also take the long part, compare it against its benchmark. Take the short part, compare it against its benchmark. Is there relative strength on the long? Is there relative weakness on the short? If there is, you can start to get a better sense as to whether this is a viable swing trade. And for these trades, I tend to keep them pretty equal weighted on either side. I try to keep the relative vol for both sides of the trade relatively similar. So the position sizing is relatively similar. And then I rebalance them every Friday, so one side doesn't get too lopsided. And folks, if you have any questions about this, feel free to leave them in the chats. I'm always happy. We will do a Q&A at the end. So I will be reviewing those questions during the Q&A. Here is the long hedged Japan short China trade over that same time period. You can see how big of a winner it was. It was up about 70% last year. That's huge. That's how these trades can really perform. This is a very powerful type of trade. You obviously have to be careful about how you manage it, how you put it on. But when you get these pair trades right in both directions, they can provide not only uncorrelated returns versus the broader, domestic and global markets, but also more powerful returns. So let's talk a little bit about entry. In many swing trades, I believe it's important to enter by dollar cost averaging in. I don't favor going in all at once. I don't think I'm smarter than the market. I recognize I'm a small fish swimming in a big sea. There's sharks, there's whales, there's all kinds of currents. I just want to flow behind those currents. That's kind of how I look at momentum trading. We're just flowing behind the currents. We're riding them to try to make some money on that momentum of bigger institutional flows. So scaling in and scaling out, or using cores and runners, allows us to take our position in smaller chunks that may give us a better overall entry and exit. And if the trading vehicle runs away from us, we can simply keep our size smaller. If you only were able to get a quarter of your position on and it just runs bonkers, fine. Let's see if it gets to our goal. We'll take that off and move on to the next trade. There's no reason to try to FOMO in late. And so the biggest basis of why do I dollar cost average? Because I don't want to assume I'm smarter than the market. I'm not, you're not, no one is. The market has to lead us. If we want to be consistent at this, we take our ego hat off, we put it on the coat rack, and we observe, coming in with no bias other than the idea that we have to see if it's qualified by price. And let's talk a little bit about position management too, because I know folks get into trades and then they get a little bit leery and maybe they cut their winners too early, or maybe they see something losing and they're like, oh, it'll come back. I'll move my stop lower. I love this theory. It has to work. I'm certain. That doesn't work. Neither of those approaches work. Okay. So once I'm in a trade, I'm going to monitor it, but I'm not going to obsess over it because I put in a bracket order. My risk and my reward are in one way or another contained. And so I don't need to obsess. I will manage my position every Friday on a pair trade, but that's about the closest I get. So I'm not sitting there watching every tick in these trades. That helps to keep my mental capital preserved so I can continue to research the next opportunities. Now let's also discuss exits. This is one of the hardest parts of trading. Anyone that tells you exiting is easy is probably either lying or they've developed some magical system they have yet to share with the rest of the world. Exiting is a challenging part of trading, whatever you are trading. Now, there are many different types of exit strategies. There's no one that is best, but you should figure out what works best for you. Some of those examples include exiting when the momentum fades. Some folks will backtest something, get an entry, get in, and only exit that trade when how they qualify momentum fades, whether it's a moving average, whether you're looking at oscillators like relative strength or MACD. That's one way. Another is exiting at a price target, which can be qualified by price action or technical analysis or options interest or some convergence of those. And obviously combinations. What I really like to do is I'll set a price target for my core, and then I will look to fading momentum to take off my runners. So for example, maybe I get in a stock at $30, I core off at $40, but I don't take off the runners unless price trades below the 20-day moving average or the trade exceeds my time frame, right? And if I'm stopped out for one reason or another, whether it's part or all of the position, I do not look back. I'm not too concerned about it. If that same setup comes up for that same thing later on, I'll trade it, but I'm not going to try to revenge trade it. I'm going to look for other opportunities to keep my capital preserved, both mentally and financially, and focus on where there are better risk reward opportunities. Dealing with losers. We all have to do it as traders. Anyone who tells you that they don't lose or they lose a very small percentage of their trades is lying. It's that cut and dry. Steve Cohen, who's one of the most prolific hedge fund managers in the world, said that his best traders have about a 60% consistency rate, right, of winning, which by the way is awesome. If you have 40% losers and those losers are small and you have 60% winners and a lot of those winners are big, you are killing it. That is among the best of traders. And losing is absolutely not only a part of trading we all deal with, but we should all be honest about it. And if we're cutting our losers, as our system says to, which should be early, not late, then we're fine. Where people get into trouble is they get married to an idea and they ride their losers lower and lower and they don't exit and they destroy their real capital and their mental capital and their confidence in themselves along the way. So keep your losers small. This is why we talked about 1% of total portfolio capital. It's really important to have that rule because then you'll always have capital to come back and trade with, particularly as your consistency improves. And let's deal with winners in a healthy way too, right? It's very possible you can be kicking butt in a trade and be like, oh, I've got the Midas touch. I can't possibly lose, right? It's really important not to get into that mindset. If you get into that mindset, you can blow yourself up just as easily as revenge trading losers. Keep the same discipline. Don't get too big in size. Don't get too confident or too concentrated. Be true to yourself and your financial goals. Will you from 3 months from now or 3 years from now look back at you right now if you're taking too big of a position and you blow yourself up and say, boy, that was worth it? No, of course it wasn't worth it, right? So when we win, we should not change our emotional state in any way. You can run a victory lap, but don't let it impact your trading. And certainly don't go out and brag to others about it because it really, once you start bragging about something you're long in, it's usually a good time to take the profits. I'll tell you more often than not, that level of confidence is often, it's like an internal contrarian indicator. And the biggest mistake people make after a winning streak is kind of thinking that they cannot lose, right? But you can. And if you start sizing up and getting too confident, you can lose big. So don't let winners change your approach or your mindset. Continue to focus on what works and improve it when you're not in the trade as you iterate your system. And the cost of lost time. This is why I do assign time as a risk factor in my trading. Okay, so it's not just about maximum capital loss. It's also about maximum time in the trade. And there's a very simple sort of anecdotal quote about this. Every time you say yes to one thing, you're saying no to 20 others. Every time you decide to take on one trade, there's a bunch of opportunities you're not taking. And the longer you're in a trade that's not working, the more opportunities you're missing that could. So I do set a time limit for how long I'm going to be in a trade because I don't want to be in something that's not working when opportunities are passing me by. I set these time periods based on backtesting because it can help you get a better sense as to when the probabilities are aligned with when such an outcome may manifest. So making it all work. Swing trading requires discipline, a systematic approach, careful risk management, and continual willingness to improve. We have to keep focusing on getting better. There is no level of perfection in trading. Once you think you've got it all figured out, the market regime or some of the underlying intermarket dynamics or otherwise change, and we've got to continue to self-improve. No matter what we trade, no matter what time frame we trade, the only constant is change, and the only certainty is uncertainty. We need to embrace that. That's the beauty of it, and that's how we can keep finding our edge and getting better as traders. It does require accountability. It requires hard work. I'm going to be the first one to tell you it's not all lottos and Lambos. It really is about building up a foundation of knowledge and executional consistency to become a trader that can not only survive, but eventually can thrive. It also means we need to be prepared to have periods where we're not trading anything at all. Particularly if you have like a period that's really difficult, take a break. There is no shame in taking a step back and reassessing and figuring out what really works for you. And that's the impetus of this slide. Do what's best for you. How I approach swing trading is not meant to be a comprehensive guide. It's also not a one-size-fits-all strategy. This is how I do it, and it's meant to try to provide some lessons that may be actionable to you. We're all wired differently, though. My psychology, the way I approach markets, the experience I have, it's going to be different, which is fine. We're all different. We all have our different strengths and weaknesses. And I always say lean into your strengths, but work on your weaknesses. And as you journal, you'll find out more and more what works for you, what doesn't, and you can adapt and evolve your trading accordingly. So let's have questions and answers time for anyone that has any questions. I'm going to start getting around to those so that we can discuss that just a little bit more. What time frame, someone asked, what time frame would I look to enter swings on? So I think that really depends on what you're trading. This is why I do back testing, right? So typically my swing trades are anywhere between weeks and months. I don't really typically go out for years on swing trades. I look at that more as like an investing time horizon. And when you go too much shorter than that, like intraday, that's just day trading, right? And there are folks that are great at day trading. I do a little bit here and there, but most of my more involved trading and my larger trading account is in swing. So for example, you may find that in natural gas, your time horizon for trading something like that is much shorter, right? Maybe it's a setup that lasts like 7 to 10 days for something to play out. And it's a much smaller position size because it's an inherently more volatile instrument. On the other side, you might find that if you're trading 10-year note futures, that your opportunity horizon is over a longer time span and your position is larger because the inherent volatility of 10-year note futures versus natural gas is much lower. So let me know if that helps to sort of contextualize what we're talking about here. All right, we're going to move on to some of these other questions here. Give me a second. Okay, so someone asks me, what do I think about averaging down longs? So I will say I don't do it personally, unless it's like I'm in a swing trade, I'm entering as a dollar cost average, and it's still within the parameters of my entry. Like we haven't broken down on a momentum basis, right? So if it's in that sense, then I'm okay doing it. But if I'm in an investment, that's also different than a swing trade. I'm willing to dollar cost average down in an investment I'm going to have over a course of years, because if my investment thesis is still intact, there's no reason for me not to continue to build into that investment, right? On a swing trade, however, I don't want to average down unless it's, in my initial entry and I haven't yet reached full size in my position and it still fits my momentum parameters. Otherwise, once the trade is on, it's on. And if, risk is going against me and momentum starts to fade, I'm going to exit that trade. It's in the rear view and I'm moving forward, looking for the next opportunity. So someone asks me, how does dollar cost averaging and bracket orders work together? It works together because you have to continue to update your bracket order. So if you're going to dollar cost average in and you're going from a quarter position to half your full position, now you've got to update your bracket order accordingly. Someone asks, RSI is a lagging indicator. How does it help in intraday? So first, I agree. Most of the indicators we look at, they're backward looking. There's really no way to predict the future with an indicator, right? So I think that's kind of an important clarification. Now, RSI is helpful for swing trading because swing trading is on longer time horizons than intraday. And it's very simply just giving you a sense of strength. Now, I think for RSI, the way I like to use it in swing trading is seeing if I backtest something where there are levels of exhaustion in an uptrend for RSI being oversold. So, in an uptrend, you want to kind of try to buy dips. You can qualify that momentum in a number of different ways, but if the momentum is still intact and RSI starts to show signs of oversold, you can start to qualify where things typically get oversold to in the context of an uptrend where RSI provides a window of opportunity, right? So that's one thing to take into consideration. Like if you're in a swing trade and you haven't built your full position and you see a drawdown and RSI gets to a level of exhaustion where there's typically a rebid and all the other areas that qualify your momentum for that trade to be healthy are still intact, that can be an addition opportunity. Just like in a downtrend, If you see RSI get overbought, that can be an opportunity to continue to fade that downtrend. Where I am very careful is using RSI to qualify overbought in an uptrend or oversold in a downtrend. I don't think it works there, and my backtesting agrees with that it's very hit or miss. When you say 1% of your portfolio for max loss, doesn't that depend on how big your portfolio is? No, it does not. So, if I have a portfolio of any size, I'm still sizing my own positions in that swing trade portfolio so that my stop is such that it's not going to cause more than a 1% draw. And the caveat there is also that stocks have so much. Sorry about that, folks. I don't know why it's getting matrixy. Hopefully it's a little better here. But basically, if I'm looking at 1% of my portfolio as max drawdown, the stop out is going to be at that max drawdown level. If I'm trading single stocks, there's obviously a lot more risk in single stocks. So I'm going to be taking even smaller position sizes on single stocks because, you can have a materially adverse event happen after hours and all of a sudden this thing's down 40% the next day, which may not fit the general volatility parameters of that stock. And that's like just one other area I feel like it's kind of important to weigh in on, that stocks have greater volatility than, industry sector ETFs or futures overall. So hopefully that's helpful. I don't see any other questions coming in. So I'm going to wrap it up here. I will post a recording of all this for you all later so you can check it out. And thanks so much for tuning in. Check out more of my work at TraderAid. We've got plenty of free educational resources on the website. If you click on the feed and the education category, feel free to take in some of those articles. Check out my YouTube as well. Got lots of content on YouTube. We also regularly do webinars and streams on TraderAid about education and commentary and analysis. So hopefully this was helpful to, kind of further along your trading journey. I'm interested in your feedback and hope to see you all around.